So Upstart reported their earnings this past week, and the stock fell hard as significant outlook overshadowed their fiscal Q4 results. Big picture, scrolling out to the monthly chart, you can see price at a level which should serve as support. Why? You have this massive W pattern, and that apex at the W should serve as support. And rightfully so, what happened was back in 2023 when price broke out, what did it do? Kind of retest that apex, right? And then you had a short bump in price, but price now could not take out the previous high. And so this support, or what was support, may not hold. Again, because price could not take out the most recent highs, which meant that the sellers are in control despite price being back at this, we'll call it support resistance band at the $25 level. Now, before we continue with the analysis, let's actually look at the results from the earnings. So Upstart reported fourth quarter revenue that exceeded analysts' expectations, but shares tumbled over 18% as the fiscal Q1 outlook came in well below estimates. So it's all about the forward guidance. It's not what you have done for me lately, it's what you're going to do for me later. For fiscal Q4, Upstart reported a loss per share of 11 cents, meeting the consensus estimates. The company's revenue reached 140 million, topping the projected 135 million. However, looking ahead to the first quarter of 2024, Upstart anticipates revenue to be around 125 million, with a contribution margin of about 61%. Net loss for the quarter expected to be around 75 million. Now here's what Morgan Stanley had to say. Upstart's fiscal Q1 outlook is meaningfully below expectations and calls into question the magnitude of origination volume recovery they may see in 2024. While persistently elevated take rates may support revenue, they remain focused on relative credit performance as origination volumes sequentially rise through 2024. Moreover, Morgan Stanley lowered its forecast for loan originations and profit expectations, but they have increased their revenue projections due to constantly higher take rates. All right, so really the question is what happens now that price has sold off and price finds itself back at this major support resistance band. And this was the rejection wick we saw on the monthly chart. On the weekly chart, consisted of 3 candles, and that third candle was red. That would have been a great shorting opportunity. All right, now let's look at the volume. This candle here, which is a extended range green candle out of the band here, occurred on, I'll say, lower volume. So not in love with the formation. This is not an A setup. I just want to highlight that this is a rally in price, a basic candle, and then the rally out. So this is a weekly buyer's level, but I'm not convinced that it's a strong level to go long. So let's go down to the daily chart to look at that level. All right. Now here's what I do like. Within that weekly zone, you do have a nice daily buyer's level. And when we look at the volume, we can see it's pretty high. Higher than average. So typically after earnings, you get a spike or a dip. There's a 3-day rule where you wait 3 days to see what price wants to do, meaning what direction it wants to go in. And so if I was to place a bet in a trade, personally I would want to see some type of confirmation that price wants to go higher. I would want to see some similar candle on volume like we saw back in December 1st before potentially going long. If you're aggressive, you can go long now, put your stop below, say $22. Look for your first target to close that gap, and your second target to be at the, say, the $36 level where you have these rejection wicks implying sellers. But overall, there's better opportunities out there. This is one where I would pretty much wait on my hands and look for a better reward to risk setup. Thanks for watching. Subscribe. Please like the video.